If you're looking at SCHD and feeling disappointed that it hasn't kept up with the S&P 500's price run, well, you're not alone. Social media is full of that kind of talk, like these sorts of posts, or you might just see a chart comparing the price. But here's the truth. If you're doing this, you're looking at the wrong metric. So the goal of SCHD isn't capital gains, it's reliable growing income. Let's take a minute and compare these funds. So with the S&P 500 or funds like SPY or VOO, the goal is capital appreciation just to keep up with the market growth. And so what you're going to be looking at to see if that fund's doing it is the total return. You might want to look at the price to earnings ratio to get an idea of, what kind of valuation it's at, and the earnings growth is what's going to drive a lot of that capital appreciation. With a fund like SCHD, if you go and look at SCHD's page and the index it tracks, the goal is quality dividend income, which means reliable growing cash flow. So the metrics that matter are totally different. You're going to want to look at the dividend yield, the dividend growth rate, and its payout history, because with SCHD, we're looking for that growing income, not necessarily to grow the amount of money that we have invested. Now, we can look at the S&P 500 and see that for dividend yield, it's not a great investment. This has been really declining since the 80s, and it really took a nosedive kind of in the tech bubble. And today, it's down around its lowest dividend yield ever at 1.13. But SCHD's dividend yield has been pretty good over the years. It's not as old of a fund as the S&P 500, but you can look, this dividend yield tends to hover between 3 and 4%. That's a much better yield on your money if you're looking for income. For every dollar you invest in SCHD, you're going to get anywhere from 2 times or more as much income just based on your initial dividend yield. So the other thing to think about here is that the S&P right now is looking pretty expensive. So this is the forward PE ratio is the main chart there. And you can see it's up towards kind of the highest it's ever been. We're more than one standard deviation away from the 30-year average. And no matter what valuation metric you use to look at the S&P 500, you can use the trailing 12 months PE. You can use the cyclically adjusted or the CAPE ratio. You can look at dividend yields, no matter what. The S&P looks pretty expensive, which calls into question, is the capital appreciation going to continue at the same rate in the next few years that it has over the past few? You're paying a fairly expensive price for those underlying earnings. And if we compare it to SCHD's PE ratio, you can see that SCHD is trading at a much lower valuation level. For every dollar of earnings, you're not paying quite as much with the S&P or with SCHD compared to the S&P 500. Now, I will admit that the S&P's earnings do tend to grow faster than the earnings of the companies in SCHD, but valuation can make a big impact there on those total returns. The other thing to consider here is that, well, the S&P 500 is really increasingly being driven by the Mag 7, right? So that concentration is growing higher and higher. Their earnings growth is outpacing everything else. And if you look on the left here, the green line is the Magnificent Seven by itself. The gray one kind of in the middle is the S&P, and the blue one on the bottom there is the S&P if we just exclude the Magnificent Seven. So the minute we take those 7 stocks out, the performance looks a lot different. And the other thing to highlight here, look at the earnings growth up there kind of in the top right. Green is Mag 7, blue is the S&P minus the Mag 7. If you look in 2023, earnings fell 4%. In 2024, they came back up 4%. We had 2 years of flat earnings growth if you just take out the Magnificent Seven. Kind of an interesting thing, especially when you consider that SCHD's holdings include none of them. So SCHD has things like Cisco, Amgen, AbbVie, Merck, Lockheed Martin, Coca-Cola, Chevron, Pepsi, Bristol-Myers Squibb, Home Depot, Verizon. These are companies that, if you think about the sectors that these are in, it's healthcare, it's consumer staples, it's energy. These sectors overall have not done as well as the things that the Mag 7 are in. So to expect SCHD to keep up with the S&P 500 when the holdings look this different is just kind of a ridiculous idea on its face, not even considering that the goals of the two funds are really completely different. The other thing to point out is that the S&P companies have really been funneling a lot of the excess cash into buybacks. You can see here again, we're over one standard deviation above the typical average, and that kind of brings into question, you know, when we think about the valuations that we saw in the S&P 500, do you really want the money going into the buybacks, or would you rather have it as a dividend? That's kind of a personal question, but I don't know that I want to buy back stock at 30 or 40 times earnings. It might actually wind up better in the long run to have that cash right into my portfolio. So here's what really matters for SCHD. This is the dividends it's paid out, and you can see that line generally increasing up and to the right. This is the point of the fund. It is not about price appreciation. And here's the growth rates of the dividend per share. These are impressive. You can see, over 3 years, it's grown the dividend more than 5% every single year. If we get longer out, over 10 years, that dividend growth rate is 10% per year. And if you've held this fund for 15 years, your dividend's grown almost 15% per year over the last 15 years. If you think about that, if we use the rule of 72, your dividends are doubling every, what is that? 5 years or so. That's pretty impressive. We don't have a 20-year number just because the fund's not that old yet. But these are the charts that you really need to be looking at to see if SCHD is doing what it's supposed to do, not comparing the price to the S&P 500. So let's go back. What matters here? The S&P 500, it's about that capital appreciation. It's about the earnings growth. It's about what are investors willing to pay for those companies. So this is all about the market. But SCHD is all about dividend income. It's all about what are the companies paying you. So this is really a fundamental fund that's all about how much are the companies you own paying you in cash directly from the earnings. What other investors will pay for them doesn't really matter. And actually, right now, with SCHD having a low price to earnings ratio and the price being low, especially compared to the S&P 500, you're able to buy a portion of those companies' earnings to come to you in cash for a lower price. So this isn't to say necessarily that one fund is better than the other, and there's certainly a place for both in a lot of portfolios. There's no reason not to own them both, but to compare them head to head and to look at the price appreciation, in my view, is ridiculous. It's just not what each fund is all about. So let me know what you think. Is this the right way to look at SCHD versus the S&P 500, or should we only care about total return? And before you answer that, think about this. The S&P has had a lot of up years, but it's also had a lot of down years. It's had a lost decade after, the great financial crisis and the 2000 bubble. If you're in retirement and you're relying on selling shares for income, that matters a lot. And during those times, SCHD, was paying out dividends, and the companies that go into SCHD paid dividends through those times. They didn't cut them. The growth rate might have slowed a little bit, but that income is something stable. It's something different. These are fundamentally different funds. So let me know what you think. Tell me if I'm totally wrong, and thanks for watching. See you in the next one.